Welcome to the Deep Dive. Today, we're getting into how companies account for certain investments. Where they have a significant say, but maybe not full control.
Exactly. We're talking associates and joint ventures.
And our main source here is the International Accounting Standard 28, IAS 28. It's been updated a few times since, 2001?
That's right. It's evolved. Our mission really is to unpack the core ideas behind accounting for these kinds of investments. Cut through some of the jargon.
Okay, good plan. So maybe start with the basics, definitions.
Sure. So an associate, that's an entity where the investor has significant influence, key phrase there, but not control or joint control.
Right. Significant influence, not the boss, but definitely has a voice.
That's
and a
right.
joint venture.
A joint venture is a specific type of joint arrangement. It's where the parties involved have rights to the net assets of that arrangement.
Got it. Let's circle back to significant influence. What does that actually look like? IAS 28 must give some pointers.
It does. It's defined as the power to participate in the financial and operating policy decisions of the investee. Doesn't mean you control them, but you're involved.
And there's that rule of thumb, right? The 20% voting power thing.
Yeah, generally holding 20% or more of the voting power suggests significant influence. It's a presumption, though, not absolute.
So you could have less than 20% and still have influence, or more, and somehow not.
Precisely. The standard lists other evidence, too. Things like representation on the board of directors.
Okay, that makes sense. Being in the room where decisions happen.
Exactly. Or participating in policy-making processes.
Yeah.
Maybe there are significant transactions between the investor and the investee.
Like they rely on each other commercially?
Could be. Or interchange of management personnel. Even providing essential technical information can indicate influence. It's about the substance of the relationship.
Right, not just the percentage on paper.
Yeah.
So, okay, let's say we've established we have an associate or a JV, and there's significant influence. How do we account for it?
The main method prescribed by IAS 28 is the equity method.
The equity method, okay. How does that work, in simple terms?
Well, you initially record the investment at cost, just what you paid for it.
Straightforward enough.
But then, crucially, the carrying amount, the value on your books, gets adjusted. It goes up or down based on your share of the investee's profit or loss after you acquired it.
Okay. So if the associate makes a profit of, say, $100 and we own 30%, our investment value increases by $30.
Essentially, yes. And that $30 gain would typically flow through your own profit or loss statement. It reflects your share of their performance.
And losses too, presumably.
Absolutely. If they report a loss, your investment carrying amount decreases by your share, and you recognize that loss.
What about other changes, like in their equity that doesn't hit their P&L, other comprehensive income?
Good point. Yes, the investor also recognizes its share of the investee's other comprehensive income. It directly adjusts the carrying amount and is reported in the investor's own OCI.
Okay. And dividends. When the associate actually pays us cash.
Right, when you receive distributions, like dividends, from the associate or joint venture, that actually reduces the carrying amount of your investment.
Oh, interesting. So it's not treated like dividend income from a regular shareholding.
Not under the equity method, no.
Yeah.
It's seen more as a return of your investment rather than a return on it, because the profits driving that dividend have already been recognized through the profit loss adjustments.
That makes sense. So the equity method gives you a kind of ongoing reflection of the investee's performance in your own accounts.
Exactly. It shows the investor's continuing interest in sharing the results and net assets. It's generally seen as more informative than just waiting to recognize dividend income.
Are there times when you don't use the equity method, even if you have significant influence?
Yes, there are exemptions. For instance, if the investment meets the criteria to be classified as held for sale under IFRS 5.
Okay.
Or sometimes certain parent companies preparing separate financial statements might be exempt. Or if the investment is held by, say, a venture capital organization, mutual fund, or similar entity.
And they choose to measure it differently.
Right. They might elect to measure those investments at fair value through profit or loss, according to IFRS 9.
Got it. And what happens if the situation changes? Like, we lose significant influence?
Then you stop applying the equity method from that date. The accounting treatment then depends on what the investment becomes.
So if it becomes a subsidiary because we gained control...
You'd follow IFRS 10 for business combinations in consolidation.
And if it just becomes a regular financial asset without significant influence?
You de-recognize the equity accounted investment and recognize the retained interest as a financial asset under IFRS 9, usually measuring it at fair value initially. Any difference goes to profit or loss.
Okay. So the accounting follows the change in relationship.
Precisely. Which kind of brings us to the bigger picture, doesn't it?
How so?
Well, thinking about this whole concept of significant influence and using the equity method, it really forces you to look beyond just simple majority ownership.
Yeah, it's not just about who owns 51%.
Exactly. It highlights how interconnected companies can be, even without full control. It paints a more complete picture, of investors' financial reach and exposure based on their ability to participate and influence, not just own.
So the provocative thought for you, the listener, might be, how does recognizing this influence factor change how we perceive corporate power structures and financial health compared to just looking at straightforward ownership percentages? It makes you think about those less obvious but still important economic links between entities.
Definitely food for thought.
Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.